Hello, my name is Yunshil Cha. The paper I'm going to present today is Company Reputation and the Cost of Equity Capital. It's written by Ying Kao, James Myers, Linda Myers, and Tom Ulmer. It's published in Review of Accounting Studies in 2015, and I'm going to present as if I were one of the authors. The research question in our paper is, do firms with better reputation have a lower cost of equity capital? So is the higher reputation related to a lower cost of equity? We drive our research question from three aspects. First, company reputation is a signal that managers in high reputation company work for the interest of shareholders. So company reputation reflects management quality. High reputation companies have high quality management. They have ability to attract talented employees because people want to work for great company. And high reputation companies produce high quality products. So if we view reputation as a signal of those attributes, management quality, ability to attract talented employees, and high quality products, then we have more information about the company. It will reduce information asymmetry, leading to a lower cost of equity. Second, firms with high reputation can increase investor recognition, thereby increasing stock liquidity and reducing the cost of equity. This second motivation is based on investor recognition hypothesis from Merton 1987. So investor recognition hypothesis from Merton 1987 assumes that in the markets with incomplete information, investors do not invest on stocks which they don't know of and they don't have much information of. They only invest on the company that they know of. This is what they mean by lower investor recognition. So when investors don't know many companies, they fail to diversify their portfolio. Since they do not diversify enough, they hold higher risk. Higher risk leads to higher expected return. Because most admired ranking will be visible to investors, business community, and the public, firms in the higher ranking are well known so that they will have higher investor recognition. Investors are familiar with the most admired companies, thus leading to less information asymmetry and lower cost of equity. Third, firms with higher reputation scores have higher earnings quality, and higher earnings quality lowers the cost of equity, according to Kao et al. In 2012. The basic idea here is that firms with higher earnings quality indicates that they are less likely to misstate their financial statement. In this case, information is more transparent and less of information asymmetry, which will lower a cost of equity. So overall, we examine the relationship between reputation and cost of equity, and we further examine whether this relationship is moderated by information asymmetry and investor recognition. Next, I will go over the research design, starting with independent variable. Independent variable is reputation. It's America's most admired companies, selected from the Fortune 1000 each year since 1983. Rating scores are based on 4,000 financial analysts, senior executives, and outside directors. And their scores are based on 8 attributes: ability to attract and retain talented people, quality of management, quality of products or services, innovativeness, long-term investment value, financial soundness, wise use of corporate assets, and social responsibility to the community and to the environment. So 4,000 financial analysts, senior executives, and outside directors evaluate firms, and the firms that score high on these 8 attributes are considered to have high reputation. Our dependent variable is cost of equity. We use 2 approaches. The first is portfolio approach and the second is company level approach. With portfolio approach, we estimate cost of equity and the rate of growth in residual income for a portfolio of companies. With this portfolio approach, we use 3 models, and we have 3 estimates. The first is analyst forecasts of next year's earnings, and the second one is current year's realized earnings, and the last one is next year's realized earning. Previous literature shows that analyst forecast is optimistic, and since the second and third measures do not include analyst forecast, they are not affected by analyst forecast optimism. And the other approach that we use is company level approach. We estimate the discount rate that equates current stock price and expected future earnings using different expectation models based on prior literatures. More details are explained in Appendix 2 for the second approach, so if you want to look at it and learn more about it, please look at Appendix 2. So this is our model. The cost of equity is dependent variable, and reputation is key independent variable. The reputation is 1 if the company is included in Fortune Most Admired Companies list in the year, and 0 otherwise. And here we expect alpha 2 to be negative, so higher reputation firms have lower cost of equity. Beta is a company's beta in previous year from CRISP, and log size is a company size. Log BTM is book to market ratio, and leverage is a natural log of long-term debt. We include this because firms with bigger amount of long-term debts are more risky. So we want to control for the risk. And dispersion is a standard deviation of last year's analyst EPS forecast. We include this to control for uncertainty in the information environment. LTG is the median analyst's long-term growth forecast from IBIS. We control for this because growth companies face more uncertainty, therefore more risky. Basically, we control for uncertainty and risk because we hypothesize that higher company reputation enjoys a lower cost of equity due to information asymmetry and investor recognition. So we control for all the possible variables that represent uncertainty and risk. Okay, so these are our results. This is Table 4, Panel A and Panel B. Panel A is for the full sample, so for Fortune 1000 companies. And as you can see, we have negative relationship between reputation and cost of equity. Here, 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 here. So across all the cost of equity estimates. In Panel B, we tested for most admired companies only that's selected from Fortune 1000 companies. We also see the negative relationship between reputation and cost of equity here, 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 here. And then slopes in Panel B is larger than slopes in Panel A. Finally, we have 3 contributions. Our first contribution is that although the relationship between reputation and cost of debt financing has been explored, the relationship between reputation and cost of equity has not been explored before. Our second contribution is that in disclosure studies, it is hard to separate managers' incentives. In this paper, sorry about the typo. In this paper, we measure reputation with Fortune's most admired companies, and this measure is free from incentive problems of management disclosure. And our final and last contribution is that the result of this study shows that higher reputation firms have a lower cost of equity. This finding can be beneficial to managers and board members who are concerned about their company's reputation.